Okay, I think this is a good time to start. So thanks everyone for joining us today. I think we have a pretty global audience. So special thanks to everyone that is joining us at the very early and very late hours of your day. We very much appreciate your time. I'm Sasha, a member of the marketing team here at Elliptic, and I'm here to welcome you to today's webinar, Fireside with the Financial Action Task Force, the October Guidance and Beyond. I just want to do a tiny bit of housekeeping before we get started. This session will be recorded and you will be sent the recording via email, so no need to worry about that. And thank you to everyone that submitted questions in advance of the webinar. We'll be trying to answer as many of these as possible during the webinar, and you still can ask questions. There'll be a Q&A box there for you to ask any questions. Again, we'll try and get to as many of these as possible throughout the webinar. But if we do run out of time, we will review all of these questions afterwards and send them to our speakers. That's really it on the housekeeping front. So with that, I will pass you over to our moderator, Liat Shetret, Elliptic Senior Advisor for Crypto Policy and Regulation, to kick off today's webinar and introduce our very exciting guest speakers.
Good morning, good afternoon, good evening. Thank you so much for joining Elliptic's Fireside Chat to discuss Financial Action Task Force's updated guidance for a risk-based approach to virtual assets and virtual asset service providers. I'm Liat Shetret, Senior Advisor for Crypto Policy and Regulation here at Elliptic, as well as your host, moderator, and court jester for our cozy Fireside Chat here. Thank you very much for joining us. It is such an honor and pleasure to be joined by the co-chairs of the Virtual Asset Contact Group at the FATF, really the meisters, movers, and shakers of all things digital assets. I'd really like to give a warm welcome to Takahide Habuchi, who is staying up quite late in Japan. And thank you so much for joining us, as well as to Jonathan Fishman, who's joining us here from DC. I'd really like to give a moment for each of our speakers to introduce themselves and then jump right into our fireside chat. Takahide, would you like to go ahead, please?
Thank you very much. My name is Takahide Habuchi of the Japan's Financial Services Agency, which is an integrated regulator and supervisor in Japan. At GFSA, I lead a GFSA at FATF meetings, and also I work as a co-chair of Virtual Asset Contact Group at FATFs since its foundation of this Virtual Asset Contact Group about 2 years ago. So I'm very honored to be part of this event, and I'm really, I'd like to express my gratitude for the Elliptics to host this very important event, and I'd also like to thank the audience for your interest in this very important topic. Thank you.
I'm John Fishman. I work in the U.S. Treasury Department's Office of Terrorist Financing and Financial Crimes. I'm the acting director for financial transparency. So I manage a range of issues there, but one of those is virtual assets or crypto assets, some of you may prefer to say. I'm also the other co-chair with Takahide of the Virtual Asset Contact Group. So you can think of me as kind of his FATF sidekick at VACG. And I'd also like to thank you, Elliptic, and the audience very much for having me. Looking forward to it. I especially appreciate those who are on at weird hours. I was just on with Asia last night, so I understand how that goes. But thanks everybody for having me. Thanks for being here. And let's get right to it. Over.
Thanks very much for that. So indeed, we have a global audience, and they've submitted a few questions in advance, and we've taken the liberty of just jotting down a few others to come up with what we hope is a compelling discussion. We've tried to identify areas in which, from our conversations at Elliptic with our customers and with industry members, we feel there might be a need for a little more clarification and insights, and we really welcome the opportunity to have this open discussion with you. So without further ado, I'm just eager to jump right in. John, this first question is for you. So with regards to the updated guidance, it really opens up with this idea that new technologies are creating new opportunities for criminals and terrorists to launder their proceeds or finance their illicit activities. The Financial Action Task Force, according to the report, actively monitors the risks relating to new technologies. Can you please describe to us how does the FATF does this? How do you monitor the risks that are relating to new technologies? How does that process, what does that look like?
Yeah, sure. There are a few important elements to that. One of them is the FATF's Risks, Trends, and Methods group, which tries to keep abreast of developments in the illicit finance space generally. And RTMG, we call it, will sort of try to keep up to date with new typologies that delegations are seeing or trends in this area. And they will occasionally release things like red flag advisories or other products that are just designed to help people stay up to date with risks as they change. So that's one way. The Virtual Assets Contact Group also meets on a regular basis, and the VACG will have presentations from delegations, sometimes from the private sector itself, about topics that may be changing or in rapid evolution. I hope some people in the audience have seen also a couple of 12-month review papers that we did after revising the guidance, which include some information about how the market for virtual assets is changing. That's the legitimate market, but also for evolution in criminal typologies using virtual assets. And then two, we also periodically have mutual evaluations and mutual evaluation follow-up reports being done. And so we will be keeping an eye on what is in those reports related to the recommendations that talk about virtual assets so that we can see the evolution through that process. And then just the last thing that I want to flag is that a lot of countries are, as they should be, are starting to include virtual assets more robustly in their national risk assessment programs. So by trying to stay up to date with reading those in our own countries, but also those that are published in other countries, we can kind of see how criminal use of virtual assets is evolving. The United States, for instance, we're about to publish an update to our national risk assessment pretty shortly here, and that will include some discussion of virtual asset typologies and how those things have changed over the few years since we last did this. So that will give people a chance to keep up to date. But this is maybe also a good avenue for me to say that we are always interested in remaining engaged with the private sector, because one of the first places that you see changes in how criminals may misuse any given financial asset is from people who work in the private sector. And so I would encourage everyone to try to remain engaged in that sort of dialogue process by being in contact with us, with the relevant policymakers that you may have in your own country, or the FATF itself, because we are always interested to hear about what the private sector is seeing, that especially where it may be new or different. Takahide, I don't know if there's anything you'd like to add to that, but I think those are the sort of the most important pillars. Over.
Thanks, John. Those are really great messages. I think not just summarizing, how you make sure that you're staying up to date on new technologies, but I think that the message of it's a two-way communication street where you're welcoming and opening industry to reach out, share ideas, share approaches, share typologies, and that makes for a super helpful public-private partnership approach, right? Where we as industry can feel welcomed and vice versa. So Takahide, turning to you, the guidance was updated in 6 key areas. We had definitional clarifications that were provided. There was a discussion of stablecoins, peer-to-peer issues, licensing and registration, the travel rule, and information sharing and cooperation amongst virtual asset service providers, supervisors. Just initially, as a part one of a 2-part question, why did the FATF focus on this short list of topics?
Thank you for the question. Let me explain the context. About 2 years ago, in June 2019, FATF finalized the part of standards on virtual asset and virtual asset service providers, along with the guidance. FATF updated in October this year. And immediately after the finalization of the FATF standard 2 years ago, FATF set up the Virtual Asset Contact Group to engage with the industry to monitor the development and also facilitate the implementation of the FATF standard. And we did a number of outreaches and dialogue with the private sectors. And also we discussed Virtual Asset Contact Group members and other countries through FATF meetings. And through that process, we identified 6 areas where countries and private sectors need some more guidance in order to facilitate the effective implementation of the FATF standard. The 6 key areas you mentioned is the ones FATF identified as a potential area that needs more guidance, as I mentioned just now.
Thank you. And as you're very, pardon me, as you're very well aware, there's been a lot of ongoing discussion about the travel rule and some of the other issues that are associated with it. What are some of the key messages with regards to licensing and registration, information sharing, and cooperation amongst supervisors that members of industry should be particularly aware of? What are some of the key messages around travel rule? What should be top of mind for industry members on the line at the moment? Thank you.
Okay, thank you very much. Perhaps I would have a chance to come back to travel rule and others later. So let me now focus on the licensing and registration and information sharing and cooperation among supervisors. And first, the licensing and registration. And let me start with what's already said in 2 years ago about licensing and registration, because it's very important. It's about when countries need licensing and registration scheme for virtual asset service providers. One mandatory thing is that when virtual asset service providers are established in your own country, that virtual asset service providers should be regulated in that country. That's a mandatory requirement under the FATF standard. And there are two optional things for other type of virtual asset service providers. For example, some overseas virtual asset service providers provide service to your country's residents. The country could also regulate such kind of virtual asset service providers through licensing or registration system. And also, some virtual asset service providers have operations in your own country, even if it's not established, or if there are no customers in that country. If there are operation of the virtual asset service providers, your country can regulate such kind of virtual asset service provider. That's the most important point. And then there are some helpful tips added to this updated guidance. And I want to share 2. First, it says, even in licensing and registration, the international cooperation between supervisors and regulators is very important because of the cross-border nature of virtual asset. And second, in times of screening of licensing and registration, authorities, both supervisors and regulators, should think about the risk of the service providers and risk of the product they intend to launch, because risk mitigation before launch should be much easier than risk mitigation after the launch of the product. And let me turn to the information sharing and cooperation among supervisors. We added the completely new section on this topic because this is important due to the cross-border nature of the virtual asset. So at the high level, there are a lot of granular messages for authorities, but at the high level, important takeaway is that this guidance promote more cooperation and information sharing between supervisors around the globe. So what does that mean? Illicit will never run away from FATF standards because by doing jurisdictional arbitrage, because all countries are now working hard to implement the FATF standard, and also they are cooperating very closely. So I think that's the key takeaway from the issues you mentioned. But I think perhaps John may want to add something.
Nope, I think that covers it really well. Thank you.
Thank you. And thanks for highlighting the key pieces around information sharing and cross-border cooperation, which is really a hallmark of the effectiveness of the FATF, the capability of taking the information sourced from all the jurisdictions that belong to the FATF and then sort of projecting that into the other jurisdictions to make sure there's effective information sharing and cooperation. Which brings me to the section 20 in the guidance, which really discusses the two types of misuse that is most common that you're seeing around illicit trafficking and controlled substances and frauds, scams, ransomwares, attacks, and extortion as being kind of the main typologies that are seen. Can you please describe some examples of typologies related to these areas that you're seeing amongst virtual asset service providers, amongst exchanges? What is the expectation for mitigation? How should VASPs really deal with these kinds of issues when they cross their platforms? And John, maybe you can kick us off, and Takahide, I invite you to also respond as you like.
Yeah, thank you. So, I mean, some of the most common or most serious threats, I guess would be the way to put it, are the things you mentioned. So if I can, let me begin with the end of your question, which is, what is the expectation for VASPs to mitigate this? So in looking at these risks or any other risks, even in approaching this whole topic, I think it's just worth remembering that the first thing that any VASP should do is assess its own risks. I think a lot of people think that recommendation 1 or IO1 of the FATF standards only asks countries to assess risks. But actually, if you look closely at it, it also says there needs to be a requirement for the private sector to do the same thing. So the most important thing to understand about the FATF standards is that they rely on something called the risk-based approach. And if you are relying on the risk-based approach, you can't do anything else, right, until you've assessed your risks, because how do you know what is most serious and what you need to mitigate? So in looking at these risks or any others, the first thing that we would always tell anyone in the private sector to do is you need to assess your own risks. And so when we highlight things like ransomware payments or large-scale cyber thefts or the use of payments on darknet markets for all kinds of pretty disturbing things, from drugs to weapons to child pornography and other exploitation, I think the first thing to do is for anyone in the private sector to step back, look at the company's own products, services, and customers, and say, well, what do I think are the most serious risks of abuse to our company? And once you've done that, then you can start to consider what your mitigation strategies should be. In looking at recommendation 15 and asking, well, what's the expectation for a private sector company? I think it begins with seeing that you have done a thorough and careful risk assessment and have designed an overall AML program that responds to and effectively mitigates those risks that you think you are most exposed to. I mean, a few elements that are mentioned that are going to be foundational for anybody would include things like being able to report suspicious activity, having the appropriate licensing or registration as required, monitoring transactions, having trained staff. You know, those pretty basic elements that are conceptually similar to what we've always had for other parts of the financial sector, like banking or MVTS. But when you are considering, well, have I done enough for the specific risks in this area? I think if you have begun with that risk assessment, if you have based the risk assessment on a coherent methodology and done a thorough one, and you can say, okay, these are the risks we believe we're exposed to, and our AML program is designed with those risks in mind and to effectively mitigate those, then I think you're on the right track in that area. Takahide, did you want to come on top of that? Over.
Yeah, thank you very much. I think you covered most of the important things, but let me add 2 things. Perhaps as you mentioned, the red flag indicator FATF published last year would be helpful for the understanding of the risk for the audience, perhaps. And the other thing I want to stress again is the importance of continuous monitoring of the new development in this space. This is one of the most exciting thing in this space, but also it entails risk. So I think both regulators and also the private sectors need to keep updated on the risk because it's changing. So it's a dynamic, risk assessment is a dynamic process, and without proper risk assessment and proper risk identification, risk mitigation is impossible. So I think the continuous monitoring and continuous update of your understanding and of our understanding is very important. Thank you.
Yeah, that's a great answer. I'm sorry, Liat. Can I just add one more thing that I forgot and Takahide reminded me of? That's a great suggestion about being aware of the FATF's red flag advisories and up to date with evolution in the sector. And it also reminds me, I should have mentioned, private sector should also make sure that you are tracking what your country and any country you're operating in has said in the national risk assessment, as well as any red flags or advisories that your FIU or FIU in countries where you operate may have said. So for instance, in the United States, FinCEN has published red flag advisories. FinCEN recently published a really interesting product that gives you an overview of what they've found about ransomware from looking at SAR reporting and other BSA information sources. And as I mentioned, we are about to publish an update to our risk assessment. So if I were operating in the United States, I would need to keep in mind, as I'm considering my risks and my mitigation, okay, well, what has the national risk assessment said? What has FinCEN published about red flags? I would want to look at that SAR analysis that FinCEN has done. So that is also something that you should be incorporating and keeping in mind. And finally, I noticed there was a question in the Q&A about whether a company has to do a standalone risk assessment if they handle other kinds of business besides virtual assets, or whether it can be rolled in together. I think the FATF is agnostic on that. You can do it in either way that makes the most sense to you. In the United States, the national risk assessment done by the government rolls everything together. We don't do sectoral risk assessments, but many countries do, and it's really up to you as to what you think works best for you. Over.
Thank you. That's super practical and direct and very clear guidance. Very much appreciate that. And just shifting to another topic that I know is very hot and heavy on the minds of many industry members is Vasp due diligence and the content around sort of Vasp due diligence. How does it work? What does good look like? I'll just here drop a short plug to say that on the 14th of December, we're actually going to be conducting here at Elliptic a very specific section on counterparty Vasp due diligence after the FATF guidance and so on, trying to get at practical and operational. But Takahide, if I can turn to you in terms of what are the expectations with regards to Vasp due diligence and what does good look like?
Thank you very much for the question. And this is a very technical one, and it's very difficult to explain. So let me explain this a little bit in detail. First, the Vasp counterparty due diligence in the context of the trouble rule is the process by which Vasp determine whether it wishes to undertake VA transfers and exchange trouble rule information with another Vasp. So recommendation 16 of the FATF standard doesn't mandate virtual asset service providers undertake counterparty due diligence. However, VA transfer can occur directly on blockchain, and the Vasp needs to identify when their counterparty is a Vasp so that they know when they need to submit the required trouble rule data to the counterparty Vasp. A virtual asset service provider or Vasp would also need to conduct due diligence on their counterparty Vasps before they transmit the required information in compliance with the travel rule to avoid dealing with illicit actors or sanctioned actors unknowingly. So I think the figure 1 of the page 63 of the updated guidance give us a kind of a nice figure of what is the general counterparty Vasp due diligence process is. Let me explain this. Only briefly. There are 3 phases. First phase is to determine whether the transaction is with counterparty Vasp or unhosted wallet. And phase 2 is identifying counterparty Vasp, as Vasp only know the name of the counterparty Vasp following the phase 1. And Vasp may identify counterparty Vasp themselves using reliable data in line with any guideline from a country on when to rely on such data. For example, as one example of such data, regulators, including the Japan's financial services agencies, publish the list of registered Vasp in their country. And also I understand some private sector companies or some private industry bodies have a database collecting such kind of information. That kind of information could be a place you could refer to in this phase 2. And let me go to the phase 3. That phase is assessing whether the counterparty Vasp is an eligible counterparty to send customer data to and to have a business relationship with. And this updated guidance say country should take a risk-based approach on who Vasp can have a transaction with. So, for example, in terms of whether you as a Vasp could make a transaction with unregistered Vasps in your country or illicit Vasps in your country, perhaps I'd recommend you consult with the regulator in your country what you could do given the FATF guidance. And lastly, let me touch up on what kind of information would be helpful to conduct Vasp counterparty due diligence. And I understand one of the tools that are widely used in the banking sector to fulfill their corresponding banking obligation is the Wolfsburg questionnaire. So while we are not talking about corresponding banking obligation of virtual asset service providers, we have some similarities. So this questionnaire, for example, could give us a good starting point in thinking about the potential framework of the checklist in the Vasp counterparty due diligence context. But I hope, given the FATF guidance this time, perhaps I hope more discussion or more exploration by countries and by the private sector will make a progress in order to make full and effective implementation of the FATF standard, including the travel rule part.
Thank you, Takahide. That's unpacking quite a technical issue nicely. I'll leave it to marinate and digest with our colleagues on the line. And if anybody has any follow-up questions to that explanation, please drop them in the chat. John, would you like to add anything to that particular question?
One of the basic rules of VACG is never try to come on top of Takahide about the travel rule, ever. So no, nothing to add. Thank you.
This is excellent banter. Excellent. All right, so we'll move on to the next topic and definitely come back to this in case it's they're burning questions, and we'll come back to that shortly. So shifting to de-risking. So this concept of shedding risk if it's been deemed as being too high risk for an appetite of a particular entity or organization. the updated guidance is really crystal clear about this, about the notion of FIs applying the risk-based approach properly, and to not resort to the wholesale termination or exclusion of business relationships within the Vasp sector without a specific risk assessment. And John, you spoke to the importance of risk assessments to begin with. So how can this be operationalized practically, and kind of what is the vision behind this? I always wonder if we're succeeding in preventing de-risking. It's a big topic for the industry. And John, maybe we can kick off with you in understanding a little bit more about, where does this topic lay?
Yeah, I mean, this is a topic that's kind of dear to me because I also handle de-risking broadly as part of my portfolio. It was actually the first thing that I picked up when I came to Treasury. So thank you for the question. The intention of the guidance is consistent with the FATF's overall view about de-risking for every part of the financial sector. Part of the risk-based approach, what that implies is that we would like to see financial institutions making individualized decisions about customers based on the specific attributes of those customers, and not making a broad, sweeping, indiscriminate, generalized, blanket, these are all the adjectives that we use, decision about an entire sector at once. So it's not consistent with the risk-based approach to say, virtual asset service providers are too risky, I'm not going to take them. It is consistent with it to say, when a virtual asset service provider comes to you wanting account services, to ask a lot of questions, to go through a due diligence process, and then say, okay, based on my due diligence, what do I think the risk of this particular customer is, and can I mitigate that risk? Because different financial institutions have different abilities to mitigate the risk, and there's a risk to every customer. And so the question is not just, does this customer carry risks? Of course they all do, but can I mitigate those? So what we're trying to do is to tell the private sector that to the greatest extent possible, I think we're really talking about the banking sector here, to the greatest extent possible, we want you to look at customers in the most targeted way that you can to make the most individualized decision possible about what the risks of a given customer are and whether you can mitigate those. And one reason for that is financial inclusion, but another reason for that is AML-CFT itself, because that really provides an incentive for VASPs to be doing the things that we want to see them doing. Because if banks and others are going to treat VASPs in exactly the same way, regardless of whether they have a strong compliance program, a weak compliance program, regardless of the product lines and customers and services that they offer, that sort of kind of disincentivizes more responsible behavior, doesn't it? We want to see that you get treated differently depending on how you are conducting yourself in the market. As far as determining whether it's working in countering de-risking, and this is something that we've talked about a great deal in correspondent banking. I think it's extremely difficult to know whether something is working per se, because you can never test it against the counterfactual. If I were to say, well, it must be working because the virtual asset sector is growing explosively, well, I mean, I don't know what would have been happening had we chosen other strategies. I think a similar approach, we can say, has made some inroads in banking, and we can say that because we see that the amount of money transferred via banks continues to rise every year, even though the number of correspondent relationships is falling. So obviously there are avenues for people to engage in that line of business. And the reason I raise that is that we've used the exact same approach in banking as we are now using in virtual assets. That is to say, trying to encourage the use of a risk-based approach that relies on individualized customer decisions. I think, I talked earlier about the importance of our engagement with the private sector. And this is another area in which that engagement is very valuable. We hope to you, but certainly to us. And that's because one of the ways we know whether this is working is what we hear from you about what your experiences with the banking sector are. If people are coming to me constantly and saying, I have tried 12 different banks, not only can't I get an account, I can't even make my case because they just ask me, what do you do? And I say, I'm in virtual assets, and that's it, they close the door. Well, that's not working. That's not what we want. If, on the other hand, people are coming to me and saying, yeah, I mean, it's hard. There's an extensive due diligence process that's kind of annoying. I was denied here and here, but I got accounts there and there. Well, I mean, that tells you that, in fact, it's probably working very much the way we want it to be. So just another plug, I guess, to say that it's very helpful for us to hear from you all about what your experiences in the banking sector have been, whether you're able to find banking partners, what kind of questions that they're asking you, how you think the relationship is going. And I would also say it's going to be very helpful for you to invest in spending the time to let banks get to know you and you them. I most often deal with this issue when it's a question of correspondent banks in the United States, the UK, other major financial centers, dealing with respondent banks and smaller financial sectors around the world, or when it's banks dealing with MVTS providers. And what happens so often is you talk to them separately, and there's been a clear misunderstanding between them about what kinds of business they do, what kinds of rules they fall under, why a particular question was asked, why a particular answer was given or not given. And I think that de-risking is very often exacerbated by that poor communication between the two sides. Conversely, we've seen that when people invest the time to make sure that banks know a lot about their business, have some sort of relationship over time with them, are able to get clear answers from them about questions, that tends to be helpful. So I guess I would leave you with the request that you try to remain engaged with us in talking about financial inclusion for the virtual asset sector, but also that you really try to invest some time in building up relationships and mutual understanding with the banking sector. Over.
Thank you for that, John. And I think something that Takahide also mentioned and you touched on is the Wolfsburg Group's questionnaire for correspondent banks, which in 2022, so next year, is going to get kind of a do-over in order to engage on Vasp questionnaires, a Vasp questionnaire that will set the standard in the same way that the correspondent bank questionnaire did. And that's something that could be very helpful in clarifying and helping kind of support the relationship between banks and Vasps. So just in the interest of time, I'm going to jump straight to P2Ps and peer-to-peers. There's a lot of things we could be talking about, but I also want to touch on the things that I know our industry colleagues on the line are keen to hear more about. So standards usually place obligations on intermediaries rather than on individuals themselves. How did you reach the conclusion that there's no consensus on the size of the P2P sector and its associated money laundering and tourism finance risks? What are some of the key messages from the updated guidance with regards to P2Ps? Takahide, if you can kick us off, please, on this one, and then we'll look forward to jumping to DeFi and stablecoins.
Okay, thank you for the question on P2P. First, let me start with the definition of peer-to-peer transaction. This guidance clarifies the peer-to-peer transaction as defined in the guidance is a transaction without the intermediary, without the regulated entities. So this is the definition. And also, before jumping straight to your question, let me also share why P2P is relevant and important to FATF. And let me share two reasons. First, this is, as you know, an unregulated space whose share of transaction may grow due to regulatory flight in light of more implementation of FATF standards globally. That's the first reason. The second reason why P2P is relevant is that if P2P transaction could grow to the extent that transactions are occurring almost entirely on P2P basis, and criminals were able to exist entirely in a virtual asset ecosystem without ever interacting with virtual asset service providers, FIs, and other intermediaries, and on and off ramp to the traditional fiat currency economy, the current FATF standard and current national regulation might not work sufficiently, and FATF may need to revise the FATF guidance, FATF standard and guidance. So this is the two reasons why the P2P transaction is important for FATF as a potential risk. We are not saying P2P, all the P2P transactions are high risk. We are saying that in this space, there is a potential risk that both countries and private sectors are aware of. And having said that, let me answer your question about about the FATF conclusion that there is no consensus on the size of P2P sector. In the second 12-month review report, FATF published July this year, we conducted market metrics research on P2P transactions, and we made a research on some of the leading virtual assets such as Bitcoin, Ethereum, and Tethers, and we also asked 7 leading blockchain analytic providers to make an analysis on the size of the P2P transaction. And in general, our finding is that the share and the scale of the P2P transaction is large, and the share of illicit transactions seems higher for P2P transactions compared with transactions with virtual asset service providers. But at the same time, the result of the research vary significantly from one service provider to another. So there's a huge divergence of the result between service providers. So that's the reason why FATF reached a conclusion that there is no consensus on the size of this sector. And also in terms of what this guidance says about the risk mitigation of the peer-to-peer transaction space, I think to put it simply, at the moment, it seems there is no one-size-fits-all solution, or there is no panaceas for identifying and mitigating the risk of this space. But as the FATF's research shows, we are still challenges in identifying accurately the size and risk of the P2P transactions. And also, we need to monitor and understand the scale and risk of this space. And this guidance gives a menu of options for countries and private sectors on how to identify and mitigate the risk of P2P transaction on risk-based approach. So let me stop here, and perhaps John will jump in if I miss something important.
No, thank you. I think that's a great summary. I mean, the only thing that I would just emphasize is I think we were all actually kind of surprised about how much variation there was in the results that we got in the research that we did for the 12-month review. So I think that just goes to show the amount of flux that there is here right now. And I encourage anyone who has a moment to take a look at those metrics. I think you'll be amazed at how different they are. I think it shows the speed of evolution, which is so great at the moment. But no, I think it's a great answer. Thank you.
Let me add one more thing. So FATF, even though FATF says, there is no consensus, it doesn't mean FATF downplays the potential, potential of the promising tool, or such as blockchain analytic tools. Of course, it seems, promising, but we can't rely entirely on those tools. I think that's the current understanding of FATF. We are aware of the potential of these tools. Of course, it could be very effective and useful, but we need other information as well. And sometimes it can be effective to use multiple tools rather than rely only on one tool.
Absolutely, the breakneck speed and the growth of the market and evolution is head swirling, to say the least. So I don't know that it's very surprising that the metrics would also be all over the place at the moment. So I guess it's stay tuned to see what the future brings us. Speaking of the future, but one that maybe is here and now already, let's chat about finance and DeFi projects, which are really growing exponentially. Funding is being poured into this space. It's a booming section of the cryptoverse. And it's really noted in the guidance that countries will need to evaluate the facts and circumstances of each individual situation to determine whether there's an identifiable person or persons providing a covered service. So from the FATF's perspective, what are some considerations that countries will be reflecting on when trying to identify whether or not a DeFi project is truly a DeFi project, therefore decentralized or centralized? What would be those specific considerations countries will be looking for? John, maybe we can start with you, please.
Yeah, sure. So I'm happy to give you a more direct answer than this, but I do want to start just by saying, the idea of making it clear in the guidance that countries will need to evaluate these individually is that we don't want to give a checklist and to say these are the exact things and you get a yes or no on these questions and that makes the decision. So I'm happy to kind of go through some things that a country might consider. I just want to make sure everybody understands this is not meant to be a hard and fast rule about how you make the decision. It's meant to say that individual facts and circumstances will have to be considered. But I think you're asking, can I give some examples of things that a country might have in mind? So, right, is that the question? Okay, I'm going to take that nod as a yes. So a few things that a country might have in mind. I mean, first at the principle level, the question for a country to ask is there some party that meets the sufficient control test? Is there an owner operator? That is to say, okay, you've said that this is decentralized finance, but that word is used for a dizzying variety of things. Is it really decentralized, or is there also at least some centralization in it, which would lead you to believe that there's a Vasp involved? So that is the conceptual principle. Is there some owner operator? Is there someone with control over this thing? Which doesn't have to be total control. And I think a few specific pieces of evidence that you might consider to determine whether there is are, for instance, does someone continue to profit from the use of it? Does someone continue to have business relationships, customer relationships or others? Is there someone who can change the protocol, who can change the rules surrounding the arrangement? Is there someone who maintains an ownership-like relationship over it? So these are things that a country would probably want to consider when they're looking at an individual company or arrangement and ask, is there an owner-operator here? Because if those questions and questions like them are answered yes, then it sounds like there is likely to be an owner-operator. But if you can truly say no to all of those kinds of questions, then you might start to suspect that this is something which is really fully decentralized and there may not be a Vasp. I should say that even if those prerogatives, business relationships, what have you, even if they're exercised through a smart contract, in the FATF size, that still counts. If you automate your control of something, that doesn't change your exercise of it. In the same way that if I go to an ATM to withdraw money, it's still the bank, even though it's been done by a computer and a machine, I guess you could say. So the same thing would apply in VASPs. If you exercise control of it, but you do it through a smart contract, or you get paid through a smart contract or something, that to us is the same as if you did it directly. But I know this is kind of a complex one, and so I just want to give Takahide a chance if there's anything he wants to add on to that.
I think I have nothing to add. Thank you very much for explaining.
Thank you for that. In which case, I'll jump off to the next topic, which is stablecoins. Also a very key piece, currently the focal point of numerous blockchain-based projects. And you've spent a lot of time grappling with this one and the potential risks that are associated and imposed by stablecoins. Could you please elaborate on what specific guidance FATF is providing on stablecoins at the moment? And I know there's been a separate report on this, but so what's new and high on your agenda with regards to stablecoins at the moment?
Thank you very much. As you mentioned, FATF published the G20 report on stablecoin in July last year. So this guidance basically incorporates the key messages of that G20 report into the guidance. And let me touch upon several key messages. First, stablecoins are covered by FATF standards, either as virtual asset or as other financial asset, traditional financial assets. Either way, they are never outside of the scope of the FATF standard. The second point is that entities within stablecoin ecosystem will have AML-CFT obligations if they meet the definition of virtual asset service providers in part of glossary. So our understanding is that most of the key players of the stablecoin ecosystem will be covered by FATF standards as virtual asset service providers or as financial institutions. And for example, the central governance body will in general have AML-CFT obligations because that body plays important role in the risk mitigation because these bodies could decide whether that ecosystem allows the P2P transactions or whether that ecosystem is permission system or permissionless system or any other important features of that ecosystem. And the third message is that risk of stablecoin should be monitored and mitigated in a forward-looking and ongoing manner and should be mitigated before launch. And I think there are some other important messages. For example, also the international cooperation of the supervisor is very important in order to identify and mitigate the risk of this space. So let me stop here.
Great, thank you for that. And I think one last piece that I'd like to follow up on before turning to the questions in the chat is around non-fungible tokens and NFTs, which are also addressed in the guidance. You know, just to quote the guidance, such assets, depending on their characteristics, are generally not considered to be virtual assets under the FATF definition. And then the guidance goes on to say that it's the nature of the NFT and its function and practice that will determine how it should be treated from a regulatory perspective. So what does that mean in practice? You know, we have customers that are developing NFT-based projects. You've got musicians from all over the globe who are rushing towards minting, artists who are rushing to mint NFTs. So what is the expectation from them? What is the guidance? And of course, it's still an evolving space. So welcome your thoughts at this point in time, obviously to be changed probably by tomorrow. But what would be the guidance today?
Yeah, I'll take that one if that's okay with Takahide. First of all, I want to assure you the guidance will not be changing until at least Thursday or Friday. Definitely not tomorrow. Don't worry. Everybody can mark your calendars. Tomorrow's a free day for changing the guidance. On NFTs more generally, though, after tomorrow, on NFTs more generally, I mean, I think what's in the guidance is that you have to consider the function that an NFT plays. And we recognize that that's a little bit ambiguous. So this is what I would have in mind if I were developing a project and I were wondering how it's going to fall and what I need to build into it. If you are developing something that is going to be primarily a financial asset, that is to say, a way that you pay for things, a form of money, or a security that meets the securities tests, that is to say that it's something that you buy in the expectation of a common economic project which will bring returns, then that item should probably be regulated by the same rules that govern the type of financial asset that you think it resembles. It should be a virtual asset, or in some cases it might be, in some countries rather, it might be a security, but the rules are very similar, or it might be treated the same way other kinds of money are, which is actually what we do in the United States, but the rules are very similar. So that kind of slots it into the, yes, this is a financial asset bucket, and it's going to have to be regulated that way. If, however, the thing you are developing is not intended to be a medium of exchange, a unit of account, store of value, a security. If it's meant to be something that people own for the pleasure of owning it, then it should probably be regulated in the same way that things like art are regulated or consumer goods are regulated. So you gave an interesting example. Let's say I'm a musician, and instead of selling, here's how old I am, I was about to say CDs, instead of selling CDs, you're going to sell NFTs of your music. Well, it sounds to me like that is probably something that is primarily intended to be owned for the sake of owning it, playing it. I've got an original copy of whatever band. So that to me does not sound on its face like that is primarily a financial asset. On the other hand, if I'm going to mint 500,000 of these things, and there's nothing I can do with them, they have no other value, they're not artistic, they're not musical, they're not collectibles, and the primary purpose of them is for people to trade them in exchange for other goods and services, or for people to trade them in the expectation that they will go up in value and be resold. Well, that sounds like a financial asset, and that should probably be regulated that way. So, you know, we were aware when we wrote this that we're leaving it a little bit ambiguous, and I know I'm leaving it a little bit ambiguous now, but I think you have to look at the circumstances of these things and say, not what could theoretically possibly be done with this somehow, but what is this intended primarily to do? If it's intended primarily and if its design suggests that it's going to be used as, let's say, a collectible, then it should be regulated that way. If what you are building is something that is intended to be and is designed to be a form of payment, then it should be regulated that way. So I think if I were coming up with one of these projects, I would want to ask, what is this intended to be used for? How is it designed in a way that suggests it will be used in that manner? And have I thought about the risks of how this could be misused? Because ultimately the principle is supposed to be same risks, same rules. So if you've thought about the risks of how something could be misused, that probably tells you how it should be regulated. So if you say, let's say for the sake of argument that you say, well, this is a collectible and I'm going to make 6 of them forever, that's it. Well, you know, it's going to be pretty hard to find a liquid market for that. So it might be quite difficult to use it to launder money. If on the other hand, you say, well, something, I'm going to make this, it's a collectible, but by the way, I made 3 million of them. You know, obviously there is a different kind of a risk there, and that may affect what the regulators are going to do, even though you may say, well, I intended this to be a collectible. So that is what I would do. I would think about those 2 things. What is this intended for and designed for? And how is it in all likelihood going to be used? And what are the risks of it? And that should hopefully lead you to the direction of how regulators are going to treat something. Ultimately, we were not trying to take things that are like art or baseball cards or music albums and treat them the same way we treat money. But we were trying to acknowledge the fact that many NFTs are being used more and more like other kinds of financial assets. They therefore pose risks and they need to be covered in that way. So I know that's a little ambiguous, but I hope that's helpful.
I think it's very clear and very direct, and the bottom line that I really walk away with is the importance of incorporating sort of risk assessments and compliance in the early days of project development, and not sort of wait until you have a fully baked model and business model, and then kind of as an afterthought consider compliance and regulatory obligations. So I certainly appreciate that. So we're at time, but I definitely want to make sure that we address some of the questions in the chat, because I know these are burning issues. So very briefly, if you can have a look at the chat, we've got a question around the travel rule and whether it replaces existing crypto industry AML KYC efforts. And we've got another question with regards to whether the FATF considers looking into the risk validator services. If you have any thoughts on any of those questions there, and then if you'd like to offer some closing thoughts, you can wrap all that in one lovely answer. Whoever would like to start, go ahead, please.
Okay, let me address travel rule 1, but also should we include my closing remarks now or perhaps later?
It's already 10 to 1. I want to be respectful of your night. It's your night and the listeners.
Okay, so with closing remarks. So, okay, Okay, okay. So that will be a tough one.
He's
but
falling
first of all,
asleep, Liat. He's falling asleep. We have to let him close.
Okay, thank you very much. I think that in terms of the trouble one, if the question, the term existing crypto industry AML KYC efforts means KYC and risk control system without server rule implementation. I think we are, and also my colleagues at the FATF is aware such kind of criticism in saying that the travel rule is incompatible with the nature of the blockchain and such that. And we are fully aware of that, and we are discussing such kind of criticism and as well. But the current consensus of the FATF, not my judgmental call or John's judgmental call, is that still the travel rule implementation for this space is the best way to mitigate risk. And I think FATF and other regulators around the globe haven't found the robust mechanisms to do the AML CFT control without implementing the travel rule. So at the same time, FATF, as well as myself, is a big fan of the responsible innovation. So in that context, I think if you think you have a very good risk mitigation mechanism or such kind of proposal, I recommend you to talk with the national regulator to think about that, because they are also the FATF participant to decide the FATF, to contribute to the FATF decision. But to put it simply, I think the FATF current understanding and stance is that we need to implement the FATF standard as soon as possible, even in a space of the virtual asset service providers and in the space of the virtual asset. That's the answer to, that's my answer to the question. And in closing, I think I want to, I'd like to introduce what FATF will do next in this space, because it's a FAQ. We very often hear. First, FATF will prioritize the implementation of the FATF standards in light of the updated guidance. And second, we will also focus on the travel rule implementation by countries and by the service providers. And third, we will continue monitoring the risk of this space, including ransomware, DeFi, NFT, stablecoin, P2P, and also we will continue engaging with stakeholders to keep updated on the recent development of this market and be vigilant in terms of the risk mitigation of this market. And in closing, I think I'd like to emphasize that the FATF's initiatives on the AML CFT front is highly appreciated and supported by global leaders. For example, the communique of the G20 finance ministers and central bank governors meeting last month specifically mentioned this updated guidance and also mentioned the FATF's second 12-month review report on this space. That means, very strong support of the global leaders on this work. So I think it's very important, but also we are always open to dialogues and conversation, and we've been participating in these types of event, and FATF has been conducting a record number of outreaches in this space in the past few years, and we will continue to engage and monitor in this space. So I think I would encourage you to stay engaged with FATF and with your regulators. And again, thank you very much. And I'm looking forward to the further dialogue as today's event. Thank you very much.
Thank you, Takahide. John, over to you, please.
Sure, thank you. Well, first, I just want to take the first question here is about 3 attributes or imperatives for a sector risk assessment in the United States. So I think that I'm going to assume the question is about if I were doing a private sector risk assessment, not for the national risk assessment. So for the private sector risk assessment, if I'm a company, I mean, I think that the three considerations to start with is, first of all, do I have a wide range of data that I've taken in, both quantitative and qualitative, including not only what's available to me in my company, but also what has been released to the public by some of the key regulators worldwide, what the FATF has said, like the red flags that Takahide talked about, whether there's anything I may be able to find from think tanks and NGOs and academics. And the key is no one data set, but just really to look at a broad sweep of them so that any little biases or tilts that you may get from one or the other are hopefully canceled out. And not to think also that only quantitative data is useful. Qualitative data also is important. So that's the first thing. Do I have a wide range of data sources? The second thing, and this may be more of an issue in larger financial institutions, but the second thing is to make sure that senior levels in my company, senior management, understands the importance of this exercise and broadly supports it. It takes a lot of time and resources to do this. You have to ask a lot of people in your company to participate, and you have to believe that the results of it will be treated as being authoritative and will be used to make real changes in the way the company operates. And so if this is something that is done by someone who's new and junior and no one knows off in a corner, at the end, nobody's going to change the way your company operates because of what this person said. So I think the second thing is to make sure that there is, in the Treasury Department, we would call it political support. I guess you don't use the word political in a company, but to make sure that there's senior management backing for the validity and the importance of this. And then the third thing, I think, is to begin by asking yourself not what the risk is, but how you're going to define the seriousness of risks. By that, I mean, how do you know exactly what it is you are looking for and trying to stop? Are you looking for the crimes that have the highest value? Are you looking for the crimes that have the most serious impact on society? Are you looking for misuse that most damages the company? I mean, how are you going to decide if you come out at the end and you say, well, I saw these 15 things in these varying amounts, how will you know what matters the most to you? Just to give you an example of how this plays out at a government level, suppose we are comparing the seriousness of a crime that may create more money for criminals, but is less serious for individuals, like, let's say, low-level frauds versus terrorism financing, where the amounts of money may be lower, but the potential impact on the country's security is greater. And there's various different ways to answer those kinds of questions that will depend on what kind of institution you're talking about. But I just think it's important before you begin to think those questions through, because that's how you know what you're looking for as you're going through the process. So those are the three things that I think I would begin with kind of as imperatives that you need to have right from the get-go. There was one other question about whether the FATF looked into validator services. This is not actually something, to the best of my recollection, that we considered during the guidance process. But as Takahide mentioned, we think it's important that we continue to monitor this area to take into account the changes in it. You know, the people in the FATF are mainly used to other kinds of businesses that don't change as quickly as this one does. And we're all coming from governments, which, let us diplomatically say, are not renowned for their flexibility and speed and dynamism. So this is a sort of an important service that we think that the VACG can provide. And so maybe this is a topic that we should look into, and I think we would welcome hearing more about it from those who think it's significant. So on the topic that Takahide was talking about earlier about engagement, this is a great example. I think it's something that we would love to hear more about from you if you think that this is an important issue that the FATF needs to look at more closely. And then finally, I know we're so far over time and we're doing closing, so just going to say quickly that first of all, I completely echo everything that Takahide said about what our next steps will be and about the importance of having further engagement with all of you. I hope in the future it can be more real and less virtual, but thank you very much for having us today. I hope it was helpful for you guys. It certainly was helpful for us. Thanks a lot.
Thank you, John. Thank you, Takahide. I know we're over time, but this has been so insightful, and we're so grateful to have your clarifications, your explanations. I think it does wonders for trust building between public-private sectors. We certainly welcome here at Elliptic the openness that you have as co-chairs and the fresh air that you've brought to the contact group. So thank you very much. We remain attentive to anything that we could be supportive of. And thank you very much to everybody who stayed on the line. Looking forward to any follow-up, and good night, Takahide. Have a good morning, John. Thank you very much to all the listeners on the line. Appreciate you very much. Take care. And without further ado, thank you very much. Goodbye.
Thanks all. Bye-bye.
Bye-bye.